Tuesday, March 3rd, the Federal Reserve announced that they would lower the interest rates as an emergency measure due to the current slowdown in the global economy, which is increasing the probability of an economic crisis in the U.S. They announced a reduction of interest rates by 0.5 percentage, from 1.75% to 1.25%. This swift cut of interest rates has been a result of the current drop in the stock market. This abrupt move by the Federal Reserve is similar to what they did in the 2008 stock market crash as a way of boosting the plummeting markets. The stock market has been reacting in an ambiguous way amidst the economic slowdown. This reduction in rates represents a change in policy from the Federal Open Markets Committee, or FOMC, which has 2 meetings scheduled to be held this month. The market is already down, and the Dow has already lost nearly 3% of its value. The recent interest rate cut has marked a dramatic change from just a week ago, when Fed officials seemed content with more of a wait-and-see approach. This is largely due to the fear that the United States economy will be affected in much the same way as China's economy, which has already slowed down considerably. This development comes as a number of American companies have warned that lower earnings can be expected due to the current disruption in global supply systems. President Donald Trump has been an ardent critic of the fact that the Fed has kept interest rates high for too long. It has long been the president's wish that the interest rates be cut so that the U.S. will be on the same page with other countries around the world. Just a short time after the Fed made their announcement, Trump sent out a tweet saying, "We are not playing on a level field. Not fair for USA." The president seemed to be referring to the fact that many other countries have extremely low rates currently. He went on to say that this is the time when the Federal Reserve should step out and lead when it comes to lowering interest rates. This announcement by the Federal Reserve came at the same time that an international group consisting of economists from the United States and 6 other leading economies, often referred to as the G7, issued a statement that warned of a global economic downturn in the near future. This meeting may have alerted the Federal Reserve to how bad economic conditions have gotten. If we trust that Powell has maintained the independence of the Federal Reserve, the most likely conclusion is that a significant economic reckoning may be coming soon. On top of cutting the rates, the Fed has also encouraged massive liquidity by injecting $120 billion into the repo market. Trump was likely surprised by the fact that the cut did not push the stock market higher, even after all this liquidity was injected. These appear to be crisis-level measures being taken by the central bank, despite this cut. But Trump is still urging Jerome Powell to cut interest rates even further. This pressure from Trump's administration reveals that the president is deeply concerned with the current plummeting of the stock market, because if there is a market crash, it will be much more difficult for him to be re-elected. When commenting on this unexpected decision by the Federal Reserve, Obama's former chief economic advisor Larry Summers pointed out the problem that Powell is facing, especially at this time when the Federal Reserve seems to have lost its credibility. He said, "When you have limited ammunition, you have to conserve it. The Fed has limited ammunition, with interest rates already too low. Interest rates will not repair the supply chains." Larry's opinion has been discredited by many in the past, but he may have a valid point in this case. The Federal Reserve may be wasting time trying to avoid an economic crash that might be inevitable. The Fed is scrambling to enact an intermeeting cut when they could have jawboned for the next 2 weeks and waited for the March 18th FOMC meeting. If anything can be said about this, it's that the cut could reduce the Federal Reserve's concerns about the markets. This emergency 0.5% cut shows how bad the current economic condition may very well be. The stock market is tumbling, even as the Federal Reserve continues losing its credibility. The markets have been held up for the past 11 years by the continuous pumping of cash into the market by the Fed, and this might prove to be a bigger problem than many realize. The emergency 0.5% rate cut has brought the 10-year yield to record lows. This situation may not have played out as well as Powell anticipated. The equities markets have also been slipping, and this is one of the factors that forced the Federal Reserve to cut rates. A spike in equity volume has translated to tight financial conditions. The stock market initially rallied on the good news of interest rate cuts, but unfortunately the effects faded away within no time, and the intermeeting nature of the rate cut has raised more questions on whether the Federal Reserve is capable of remedying the situation. The Fed is willing to cut rates further, but the extent to which they're willing to do so still remains unclear. If the intention of the FOMC is to exercise the interest rate cut only one time, then this message was not well communicated to the financial markets. There is a high probability that the next cut will be a 0.25% cut, considering how the markets have responded to the present cut in interest rates. But based on the response, it is difficult to imagine that a 0.25% cut will be met by the same warm embrace that the monetary policymakers have been accustomed to. There is also a lot of fear that Powell is acting too aggressively. This can signal that the situation could become worse than what is currently being experienced in the markets. This is the first unscheduled interest rate cut since 2008, and it's also the most sizable cut since then. Typically, the Federal Reserve cuts interest rates to stimulate growth if the economy is slowing. This works by boosting consumer confidence in the economy, and it also incentivizes consumers to spend more money. To most people, the question remains, what effect will this interest rate cut have on Wall Street? And what does this mean to you as an individual? The cuts may or may not boost the economy as expected, but they will certainly have a great impact on every person in America. This fiscal stimulus is something of a last resort for the Federal Reserve, and Powell has still left more room for additional reduction in interest rates. In a statement that was approved unanimously, the Fed policymakers said they are closely following developments that could put the economy at risk. The current benchmark for interest rates is 1 to 1.25%. The Fed is willing to lower rates further, and if they do initiate more cuts, we will soon find ourselves at the point of reaching zero or even negative rates. This is what President Trump has been advocating for, even if economists are arguing that low interest rates are less likely to solve the economic challenges facing the United States. The latest data on domestic manufacturing and consumer confidence indicates a slowdown in the economy. The big concern everyone has is how long this slowdown will continue. Some economists are predicting that interest rate cuts will not help, and if things don't change, this slowdown can gradually culminate in an economic collapse. Powell announced that the Fed is expecting low interest rates to boost business and consumer confidence, while at the same time bringing more support to the credit market and the financial system at large. He has continued to insist that the Federal Reserve will keep making its decisions independently without being influenced by politicians. Trump's administration is said to be considering a proposal for a temporary payroll tax cut as part of the stimulus to prevent this looming economic recession. Many economists believe that a payroll tax holiday could be effective if consumers pull back or if the economy begins to lose jobs. Other measures that the administration can take include providing financial aid to states and extending benefits to the jobless. However, we are in an election year, and this will make the implementation of such policies difficult. It is very clear that the Federal Reserve is initiating crisis-level stimulus to the stock market and the economy as a whole. Usually, interest rate cuts are the Fed's last bullet in combating economic downturn, and they have already fired it. This indicates that the whole economy is on the verge of collapse. The US economy is at a very dangerous point. And what we're seeing right now is the initiation of emergency tactics to improve the situation as quickly as possible to prevent the collapse of the entire economy. The United States is already in a serious economic slowdown, on top of massive debts and bubbles in various sectors. The Federal Reserve is doing what makes sense in their institutional context, but the truth is, the economy is at a dangerous point, and many structural changes have to be made to prevent a recession. Cutting interest rates alone is not enough, as it only offers a short-term solution, not the permanent solution it sorely needs.